Everything should be good, so I guess we could start. Hi everyone, welcome to the open semifinals of this year's Sunway Asian Parliamentary 2024. Congratulations to both teams for making it this far. My name is Palatena. I'm going to be your chair for today. My pronouns are he or they, although I prefer if you refer to me or anyone in the panel as just simply the panel. We have four other panelists with me, if they wish to introduce themselves, starting with Jill.
Hi everyone, my name is Jill. Pronouns they, them. Good luck.
Hi, I'm Sam. Pronouns he, him. Good luck.
Hi, I'm Tanis. Pronounce him. Good luck.
Yugnesh here. Good luck for the semis.
Okay, so debating on a motion, this House supports restrictions on share selling by major hedge funds in times of stock market crisis. If ever anyone chooses to redact their consent, just let us know so that we can stop the recording. And also, please keep your own time since I will be tracking the debate, so I might not have enough time to put timestamps in the chat. Sorry. Okay, sorry. OC just messaged me, but it should be resolved. To not delay the round any further, we're debating on the first motion. Prime Minister, whenever you're ready.
Just checking I can be heard.
Yeah, you can be heard.
Okay, fantastic. POIs, put them in the chat, please. Don't unmute or anything like that. I'll ask for one explicitly, probably around 5 minutes. Okay. We think crashes are caused by a systemic lack of information and a failure of previous markets to accurately predict and model price. We think, given the structural lack of information, there is an inefficiency in terms of how investors act in these periods. And we think this causes A, a change to incentives, but B, a more efficient allocation of capital as a realignment of how people actually engage in the market. First, a couple pieces of setup. I think these restrictions are probably done by central banks. They're probably going to look for relatively important indicators, A, to determine if we are in a crash, but B, after the crash where we've reached a period of relative stability. We think that these things like going to look like bans to selling or limitations on the amount of a stock that you can sell in one go. We think there's also probably not going to last incredibly long, probably a few weeks or a few days to the point at which the market is relatively stabilized. Second, what do we think causes crashes? As I said, it's probably due to some unexpected failure in the market, which has caused previous pricing in the market to quickly become inaccurate. This could be due to things like exogenous shocks like COVID or some other thing that has rapidly changed the nature of the economy, but very often it's because of some unexpected factor or a failure of models, which means that the prediction of price into the future has become rapidly inaccurate. Note, we think that in these contexts, when markets rapidly readjust to reflect price, which is what actually causes the crash. First, characterization of hedge funds. I think it's important to note that hedge funds often have very wealthy investors because they tend to be firms that engage in higher risk, higher return types of investments. The reasons they engage in these types of investments is because they have large teams of analysts and predictive markets, which means they are able to take on riskier positions and be able to do that in an efficient way where they are certain or likely to make profit. We think they're also highly diversified. Two, we think they have a large signaling effect in the market because they're perceived as having the best information. So we think even when hedge funds act, it often signals to other investors what they should or should not invest in because it signals that this firm is likely to fail due to the analysis of this firm. Third, we think that they often have enough capital to be meaningfully impactful on the price of a stock because they often have billions, if not trillions of dollars, which means that a hedge fund does probably massively affect the effective pricing. Alternative investors are things like pension funds, which tend to be lower risk, but still very valuable. And we think they probably aren't as able to quickly respond or sell in periods of crisis, A, because they generally just don't have that degree of diversification, but B, they're not as responsive due to how they work. Yeah, I'll take clarification.
So let's say these investors want to pull their money out of the hedge funds. What will happen then?
Yeah, so I think probably they won't be allowed to. So this is relatively common. I think in some circumstances, certain types of funds put restrictions to the capacity of investors to pull out. We think similarly, like banks impose restrictions for people to pull out certain amounts of money during periods to prevent bank runs. This is not relatively uncommon. We think we're probably relevant and capable of doing that in the circumstances. One, why do we think investors sell poorly during crises? There are 4 reasons for this. One, there is a structural lack of information. That is, crises are relatively opaque for the reason that crises are caused by an unpredictability in the future of a market, which means the types of things that have caused crisis, you aren't able to see the total scope of what the actual outcome or circumstance of the crisis is, which means the information you're making decisions on is actually vastly limited. 2, risk mitigation. Because previous models have failed, this doesn't mean you were unable to predict the crisis previously. It means there was some failure in the existing models of your analyst that was being used to make decisions, which means you're probably unlikely to make accurate decisions. This means that the types of behavior that hedge funds engage to shifts to risk aversion and saving their assets in terms of selling off assets rather than engaging in productive allocation of capital in markets. 3, the actual structural incentives to sell off in bad ways. That is, hedge funds have other things like put options, which require constant pay-in. And so during periods of crisis where they're fearful about shortage of capital into the long term, they're likely to sell off otherwise valuable investments in order to get the short-term injection of capital to pay for other positions. We think this means to a very inefficient and bad allocation of capital. 3, we think they can sell poorly and it's based on inaccurate information. We think the worst case scenario from what they say is that investors don't have access to money. We know that these are relatively wealthy individuals who don't necessarily need the short term of capital in the 1 week that they have during the period of crisis where there's no opaqueness of information. We think the marginal inability to access that short term injection of cash is relatively negligible in this debate. On the comparative, we think this delay forces investors to wait until more information is available, where their models and analysts are more accurate, and therefore the allocation of capital and the selling is actually more reflective with the goals of the market into the long run. We think this is comparatively better because we think markets are good at efficiently allocating capital, but that requires necessary knowledge of information within the market. Second, why this disincentivizes risky behavior. The position here is that hedge funds and status quo engage in very risky market behavior, which actually causes the beginning of crises or crashes in the first place. And this creates disincentives to do that because they know they can't passively pull out cash in cases where they're bad, right? Note, we think that there are a couple of reasons for this. One, hedge funds are able to uniquely weather crises and circumstances that other investors aren't necessarily able to. They're relatively diversified, so localized shocks probably don't affect them massively. We think, secondly, they have often first mover advantages, which means if investors get fucked over on net, we think hedge funds are the ones who are able to have those short positions, or they're able to take on the very high risk investments, or they're able to be the first ones to buy into the market after a crisis, which means they have a first mover advantage where they can often actually gain a profit as a consequence of crisis, where other investors aren't able to actually do this. This often causes them to engage in incredibly risky behavior, i.e. things like speculation on mortgages to weapon a housing crisis, because they knew that if something like that happened, they would either make a profit as a consequence, or the effect to them would be negligible relative to other investors, while they could make immense profit in the short term. Which means then that this actively disincentivizes this for 2 reasons. One, you can't sell during periods of crisis, which means you put other parts of your positions in to some degree of risk, which means that you probably are now actually disincentivized from doing that because you can't get that short-term injection of capital to pay for your put options, which is presumably bad. And 2, we think is probably the most proximate impact in this debate, because if we prevent some margin of crises, this is prior to any other analysis about selling during crises, because we just think we got on net fewer crises because of the shift in the incentives of hedge funds. 3, outcomes. We think inefficient allocation of capital is super important in this debate. We think at the point at which otherwise good firms get fucked over because their stock price tanks due to no fault of their own, this leads to a couple of things. One, we think that these firms are unable to access loans because note the loans are often based on the stock valuation or the valuation of their company, so the capacity of short-term injection of capital that these firms might need to respond to things like exogenous shocks like COVID becomes massively restricted. But 2, it means that they can't do things like issue new shares in order to get a short-term injection of capital in order to save themselves from bankruptcy during these short-term crises, which means otherwise good firms fail. We think that A, prolongs crises because it means firms that it means that the uncertainty, because once one large company like Evergrande goes bankrupt, this creates massive future uncertainty in the market, which probably prolongs and causes future crises. But B, it means the more important signals of the economy, which is not value to investors, but people's jobs and the stability of the economy and just the GDP generally goes down and gets spoked over in the long term, which is probably a more impact in this debate. On the comparative, we think that we provide some degree of stability for these firms able to get short-term injections of capital during the initial stages of these crises, which can stop them from going under because their stock price is relatively stable and it doesn't spook investors from fully pulling out and using a signaling effect to fuck other people over. We think on that basis, you think recovery is faster. A, we address these underlying crises. Final thing they say is that they might say that this allows bad companies to go under. Note that if there is some structural problem with a company that means it ought fail, we think in these circumstances, you can sell after the crisis period is immediately over, so in the 1 week after the immediate short-term shock, or you can sell at any other part in the economy to readjust your models. We think bad firms are still going to continue to fail. The things that we save are the otherwise good failed firms that are fucked over by things that are outside of their control. For all those reasons, we are so proud to propose.
All right. We thank the Prime Minister for that speech. Moving on to the Leader of Opposition. Here.
Ooh.
Hey, can I be heard? Just checking if I'm audible.
Yes, you can be heard.
Okay, great. Sorry, just give me a second. Okay. Starting my speech in 3, 2, 1. I think ultimately, at the end of the day, hedge funds may not always act perfectly, but oftentimes, because of all of the reasons that they gave, all of the characterization that they gave, that hedge funds oftentimes involve a large amount of money, stuff like that, and oftentimes are invested in by the most wealthy. Oftentimes, hedge funds are the ones that are most likely to be able and the most capable of actually aiding things like economic recovery when everyone is struggling, so proud or poor. That's a very quick rebuttal before I go on to my 2 points of the house today. The rest of my rebuttals will be integrated. All right. Note, I think they basically say that, oh, obviously you need restrictions on hedge funds, or else there are things like their risky behavior would lead to other people for example massively pulling out, and then that leads to economic crises. But recognize that their side actually wasn't that a lot more, or is at the very least quite symmetric, because recognize that as you mentioned, currently in the status quo, people oftentimes see hedge funds as a good signal for how to act and behave economically. But insofar as you enact these laws on gov side, they oftentimes no longer have this mechanism, because when they see that when they see that the hedge fund is being massively restricted and they see that they're not doing certain actions, they oftentimes are not going to say, oh, this is because this is a good thing to do economically. They're going to jump to the whole idea of, oh, it's because the government is restricting them. I think that oftentimes a lot of these other states are still going to succumb to this hysteria, and they're still going to sell anyway. So I think that the economy is going to be fucked either way if there's the entire mechanism of how hedge funds are a massive signaling force. All right. 2 funds, so ultimately it's going to be symmetric, or at the very least, it's just only going to be marginally worse on our side. All right, 2 points for the house today. Firstly, how hedge funds are less likely to invest in normal times and why that's a bad thing. And secondly, how this prevents economic recovery during the times of crises when they do happen. All right. Why do you think firstly that hedge funds are less likely to invest during normal times? And this is where I engage with the case where they basically mention that hedge funds are going to survive anyway, which makes them incredibly likely to take risks, even when they're not the case. We think that this is just incredibly unintuitive. We posit instead that hedge funds are at the very least a lot more cautious on their side, and that's not as yeah, they become a lot more cautious on their side, and that's not necessarily a good thing. Because firstly, they recognize that they're just very risk averse, insofar as they are accountable to the people who invest money in their hedge funds. Yes, at the same time, these are incredibly wealthy people, but at the same time, these wealthy people are investing a lot of money. They probably don't want to lose it all in one shot. They're probably still going to be accountable to these people to a very heavy degree. They're probably going to be incredibly risk averse. But secondly, recognize the nature of the economy. They oftentimes the way that the economy works is that whoever tends to be the fastest, whoever tends to be the one who pulls out their money the first, and makes any sort of action first, tends to be the one who wins any sort of outcome. And so oftentimes these tend to be incredibly trigger happy. Why is this so bad? Because firstly, during normal times, they just think that insofar as there's this mindset that economic crises can come on at any time, which is a characterization that they obviously agree to, they are oftentimes going to invest far less heavily in general, because in the case where they aren't actually able to actually pull out in time, they're just fucked over. So they just want to decrease their investment in general. So what does this mean? I'm going to elaborate on this later, but we think that in general, even during normal times, this results in more less investment in smaller businesses, less investment in other things, which obviously results in less economic stimulation and less economic growth, even during your normal times, even times where we think people should be enjoying their prosperity. But secondly, let's talk about the times of crises, and more importantly, the very initial stages, because recognize that actually there are quite a lot of things that may signal danger, but not all of them always result in that danger. Recognize that obviously a new disease outbreak may happen and may cause a pandemic a la COVID, but at the same time, not every single thing is going to result in a pandemic. It's just very intuitively true. We think that if we were to consider every single small signal as a sign of a total crisis, we'll have a lot more crises on our hands. But secondly, like there exist other actors that may improve the situation and may curb it. For example, governments can like have a very early lockdown and result in small things like not escalating become such big problems. What's the problem then? Then hedge funds have to, when they realize they're not going to be able to do things like sell their stocks in the time when the actual crisis like hits, they're probably not going to be willing to actually wait out and take that chance. As I already mentioned, they're incredibly risk averse. That's not an incredibly good thing. So what does this result in? This results in them like this results in them, for example, massively selling all of the stocks before the crisis even sets in, because the idea of them being wrong, the idea of them not selling and in a week having nothing but useless stocks and potentially bankrupting the company, that's something that probably is the worst case scenario for them. They want to avoid that under all costs. So they do things like immediately sell, and oftentimes this results in like an influx of stocks and devalues it greatly. So why is this incredibly important? Because it's true. Like, when they say that it's a signal of a crisis, like, yes, that's true, because people would then start selling, everyone starts selling, which will obviously devalue the stock even more. And this oftentimes artificially creates crises that might not originally be there, because oftentimes you just didn't wait, you weren't willing to wait, you didn't give them the time to wait. And like, oftentimes these are what is like, time is just what is necessary for these small crises to blow over, have like result in like smaller things, resulting in things snowballing more. We get more crises on their side. But before I go on, any POIs? 3, 2, 1.
Yeah, so presumably, right, what you are failed to prove is why selling stocks during a period of crisis is at all good for these companies, right? Presumably selling stocks for all the reasons I gave is based in a period of market opaqueness.
All right, so secondly, I'll be talking about why allowing them to sell their stocks actually is incredibly important in preventing, in helping the economic recovery. So why exactly, why is this important? Because firstly, hedge funds are a major source of economic recovery. Like, investment in other institutions and other smaller businesses is generally incredibly something very important. And so when you have increased capital, you're better able to like do things like aid in the economic recovery, which is incredibly important, because obviously as businesses go under, you probably cannot continue paying your workers, and like you cannot reinvest in the economy. And this is incredibly important because we enable like hedge funds to do that better on our side by firstly encouraging people to continue like investing in the hedge funds, even by encouraging people to invest in the hedge funds. Recognize when people, like, obviously the rich people are also oftentimes incredibly scared of the very regulations that you state. When you say that rich people oftentimes cannot pull out their money, oftentimes this results in them investing even less of their money in the hedge fund in the very first place. So oftentimes, like, the hedge fund just has far less money to be able to spend on other companies in the very first place. But secondly, we actually allow them to reinvest them into more efficient areas. Obviously, as you mentioned, like, they've already mentioned why crises like happen, when they realize that the value of one industry is inflated, and then obviously people start selling in that one particular industry. But if the hedge funds cannot sell, they're stuck holding useless stocks in like housing, even when they're massively devalued. When you can actually sell them, you can liquidate all of these stocks, you can liquidate all of these assets, and then actually reinvest it into one more efficient industry, and number two, industries with a lot more potential. Insofar as these, like, the industries everywhere are failing, you actually being able to reinvest in the one industry that's succeeding is actually probably incredibly good for the economy, and you actually are like supercharging all of the ideas of economic recovery on our side, insofar as you better enable a more efficient allocation of resources on our side. This is exclusive. So proud of.
Okay, we thank the leader of opposition for that speech. Reminder for debaters to please keep speeches within 7 minutes and 15 seconds. Moving on to Deputy Prime Minister. We thank the Deputy Prime Minister for that speech. Moving on to the Deputy Leader of Opposition.
Hi, just doing a quick mic check. Could I please check if I can be heard?
Yes, you can be heard.
Excellent. POIs in the chat, as I mentioned earlier. 2 questions in the speech. Firstly, who prevents future crisis? And note that DPM grossly misrepresents what we said. What we actually said was that hedge funds are the ones who will be pulling out earlier on their side of the house. The very premise of the government bench is that during times of uncertainty, hedge funds turn from rational actors to irrational actors. They sell off their stock quickly because they believe that other actors will speculate as well, and they tend to do speculation. But note that the exact same tendency of speculation of irrationality kicks in even earlier in the government bench. This is because any signal of crisis implies that the hedge fund might be forced to hold on to stocks that are devaluing very, very quickly. For instance, if it is the case that any signal of a pandemic means that I might have my ability to sell my stocks frozen by the central bank, it means that the rational thing to do is to get ahead of this policy from the central bank and sell my stock before I'm forced to hold onto worthless stocks. And note that if I'm forced to hold onto worthless stocks, this is devastating to me. Overnight, like governments can tell me about 1 week or 2 weeks all they want, but overnight stocks can plague a massive plummet. Other actors begin speculating. Other actors speculate the point at which they believe that the only reason why the hedge fund is still holding on to stock is because they are forced to. That is the point at which other actors begin selling. When that happens, hedge funds lose trillions and billions of dollars because they literally are left holding the bag on worthless stocks by the time the period is lifted. This means then that hedge funds begin selling earlier. They begin selling more often. Investors begin pulling out their money out of hedge funds themselves because they don't trust the hedge fund to be telling the truth, because they don't want their money being held by hedge funds which are not going to be able to return money for them, no matter how much the investment bankers reassure them. All of this implies then on government bench that their harms are symmetric, but their harms are multiplied because it happens earlier in the cycle. Before the crisis gets bad, hedge funds are already looking to pull out. And if it is the case that their own logic says that these are trusted actors, that other market actors trust and believe are the signalers of future crises, this means that crises will multiply. Hedge funds pull out earlier at any signal of crisis. Anytime the share of oil takes a dip, anytime that there's a small famine somewhere, anytime that there's a epidemic that might spiral into a pandemic, hedge funds begin pulling out. All of this then multiplies the number of crises in their world. Government bench tells us that people are rational and don't need to keep the money in the economy. That's factually untrue. Their own case relies on hedge funds, the most rational of them all, acting irrationally. Clearly, if hedge funds can have this tendency of speculation, other actors like retail investors, like regular large investors as well, can do the exact same thing. This material is contradictory at best and untrue at worst. What's the weighing here? The weighing here is simple. Government bench multiplies crises. The sob stories that they tell you of the poor fella losing his job happens more often in their world when more people loses their job, so when more crises occur. But it's worse than that. The fact that there are more crises means that it's harder to get out of crises. Governments usually recover from crises by drawing on their reserves and stimulating the economy. You can't do that if crises occur too often because you run out of reserves to do. The ability of states to borrow money is decreased because states around the world go through way more crises such that it's harder to do that. This means then that debt of the house has more crises. But even if you don't buy that there are more crises occurring, the general tendency of investment banks not to invest means that they generally get less growth. And if you think about it, the harm of an economic crisis is that there's less economic growth for a period of time. If you just multiply that across a long period of time, even if they get fewer crises in their world, at the absolute best, less growth also means that fewer people get jobs. It's just that this occurs over a longer, more extended period of time. The weighing here kills their case because in their side of the house, they don't get any of those benefits, the point of which is occurs in their side. Point.
Yeah, the problem is hedge funds don't generally invest in firms during crisis because they feel there's a lack of information, so they can't make logical or smart investments. The way that firms recover crisis is by taking loans against the valuation of a company.
Actually, that's going to be the material I'm going to talk about later, but even if that's true, that's independent of my first argument. My first argument is a debate-winning argument because it proves that the harmful effects of Gulf's case occur more frequently earlier in the crisis, makes it harder for states to recover from these crises. This clearly takes out your case. Second question then on why we help crisis recovery better on our side. We explain that hedge funds play a critical role in crisis recovery. They tell us that, and the intuitive reason for this is that crisis recovery requires money. You need money to be able to recover from crisis because you need to invest in businesses, etc. Government bench has two responses. The first is that they already have lots of money. Sure, they have lots of money to an average person. They have millions of dollars in liquid reserves. But compare that to the billions and trillions of dollars that they would have if they sold their stock as well. This means that when they sell the stock, they can reinvest massive amounts of money, and that's a far better thing on our side. The second response is, and this is especially good for the very reason that when it comes to stocks that are sold in times of economic crisis, these stocks tend to be concentrated in economically inefficient sectors. The 2008 crisis was a great example of this. There was a housing bubble. It was not irrational to sell housing because housing was overpriced by the market. This means that it is a correct thing for the economy to do to sell massive amounts of stock in the housing market and invest it elsewhere where it actually will generate proper returns. Government bench doesn't allow for this, the point at which they're trapping all of this capital in inefficient parts of your market, like housing, for instance. But even assuming that the price of housing doesn't plummet in their world. The second response they gave was the one in the POI just now. They tell you that hedge funds don't want to invest because they view it as too risky to invest in times of crisis. Number one, hedge funds have incentives to invest because the stock price is very low. Any investment is cheaper, and so that's like it's a supply and demand curve. The price goes down, demand goes up, etc. It's very straightforward economics. Secondly, there are also other things that can cause hedge funds to invest. Government stimulus packages, for example, that signal that economic recovery is in time. Note that hedge funds play a unique role according to them. They tell you that hedge funds signal to the market that there is time for a crash to occur. We point out that that is also true in the reverse. Hedge funds signal to the market that it's time for the market to recover. Other investors get more confidence when hedge funds invest. They can do this better on our side when they actually have the capital to invest and when they actually are able to do it as well. When they have the money to do so, they're highly likely to do so. The last thing they tell us is that other investors, hedge funds are uniquely large and therefore, if we stop hedge funds from crashing the stock, other investors will not crash the stock. We have three responses. The first is that that's an assertion. We can equally counter assert other actors have lots of money. Think of your investment banks, your Lehman Brothers, your venture capital funds, your Warren Buffetts of the world. All of these are investors with massive amounts of money as well. Hedge funds are not the only actor with lots of money in the economy. When hedge funds don't pull out money, these other investors will pull out, either because they see the central bank freezing the hedge fund and go, shit, this is clearly the start of an economic crisis. Other actors will pull out. I better do it faster. Secondly, they tell us that hedge funds are a uniquely powerful signal. Note, my first argument already takes this out. But secondly, the fact that you are having your assets frozen also sends a very powerful signal. Note that in order for the benefits to be true, the central bank has to get out ahead of the hedge fund. This means that this powerful signal is sent far more frequently. Other actors pull out their money even more. Crises exacerbate in their work. They don't get much better. Thank you.
All right, we thank the Deputy Leader of Opposition for that speech. Moving on to the government web.
The op case in this round is based off multiple fundamental misconceptions of how exactly the market works and why liquidity is important for companies and when. I'll be explaining exactly why. First of all, explaining the way that signaling works and the way that avoiding crises works. Second of all, in crises recovery and who gets better crisis recovery. So first of all, let's talk about signaling effects and the way that risk-taking affects the market. Note that first of all, I think that like the characterization that overnight stock trading, that stocks can drop a bunch overnight is true. But the thing is that, as the second already told you, we think that the way this is likely to manifest in banks is that there's an automatic cutoff. So if the Dow Jones drops more than like 800 points within like 10 minutes, then you automatically cut off before there's ability to react. So I think that we are able to very efficiently react to these markets. Second of all, it's unclear in the first place why you have this like hair trigger mechanism of wanting to sell really early, because the reason in the status quo that you want to sell early is you're worried that other firms will sell earlier than you and you'll be stuck holding the bag. But note that to the extent that all firms are governed by this at the same time, there's not this incentive anymore. And so that nobody is going to be worried that they're going to be stuck with the bag. This means that they're far less likely to invest like this. Third of all, I think that even if it's the case that hedge funds are likely to sell relatively often, to the extent that they do this often, they lose their signaling effect, which means that other market participants no longer follow them. This means that the types of economic harms that you get on their side of the house are relatively minimal, to the extent that it's only this one sector of the financial industry and other sectors aren't following them. But lastly, I just say that the analysis on why hedge funds act this way that they give you is very, very uncharitable and unreasonable. Note that selling all of the time is a really shitty financial strategy, right? If you have to sell every other week because there's a tiny market signal, you're probably losing a lot of money and leaving a lot of money on the table. What's the alternative strategy that hedge funds are very likely to follow that comes out in our first and is never addressed? It's diversification. Every other market participant, when you're worried about downside risk, just diversifies rather than selling all of the time. And I think that this is actually much better in our side of the house. It means that you have things like short positions. It means that you have a wider portfolio across multiple industries. And I think that this is a likely manifestation of how hedge funds deal with risk rather than selling all of the time, because it's like much more financially efficient. It doesn't require a huge amount of manpower just hitting the sell button every other week. Note that this then is much better for the economy, because it means that hedge funds are in less risky situations, and so they don't need to sell as much as early. But second of all, I think it means that they engage in less risky behavior in the long term. And so it means that when there are economic crashes, they're much smaller to the extent that they're outweighed by other positions. And so, for example, you don't have a huge amount of investment and bubble popping in the housing industry because hedge funds have this incentive to be more diverse and to not take such big risks. This means that you actually get far fewer fewer, I'll take POIs in the chat. You actually get far fewer types of things in the long term. You actually get far fewer crashes. And when the crashes happen, they're probably a lot less severe on our side of the house. Additionally, let's talk about recovery then. First of all, I think that our analysis on recovery is extremely strong. We tell you that to the extent that you have far less confidence in the market, people are less likely to invest. Why do you have less confidence? Because when the stocks are fluctuating a huge amount, because you have large market participants that are selling a huge amount, then that's probably quite bad. Additionally, I think that to the extent that firms go under uniquely on their side of the house, because of the fact that firms can't access liquidity from banks and governments, because of the fact that firms can't use things like their stock as collateral, that means that firms are likely to lay off employees. They're likely to result in general economic collapse and malaise just because of the fact that when you have people who don't have jobs anymore, they can't stimulate demand. This means that you're likely to get things like 3-4 year long depressions when you have precisely these things happening. The analysis that they then give us is that on the counterfactual, you are much more able to invest in better industries. Multiple problems with this. First of all, note that the fundamental assumption behind this entire case is that hedge funds know who to invest in, but this is highly unlikely in times of crises. A few reasons. First of all, note that to the extent that crises happen, they're oftentimes very transient in certain sectors. Look at COVID and under COVID, things like airlines and hotels, which are fundamentally good industries and quite successful in other cases, had a short-term collapse. This means that to the extent that you allocate away from a bunch of them, in the short term that might be good, but it's actually bad for recovery because it's not helpful. Additionally, look at real estate companies right after 2008. Look, I think that home buying is general a relatively good investment, but when you have a short-term collapse, to the extent that you invest out, you're probably investing out of an industry that's relatively good. But second of all, I think that to the extent that there's a large degree of panic, you don't even have time to assess which industries are good or bad. And so when you're changing industries, you're probably just doing it off an intuition, which I think is relatively unreliable. The implication of this is that none of their benefits materialize to the extent that they can't claim that hedge funds are actually able to allocate well. Additionally, I think that there are large uncertainties, which means that people don't invest in the first place, right? So I think that to the extent that there's large uncertainties in the market on their side of the house because there's a lot of economic activity, like a lot of selling, probably it means that nobody wants to invest in the first place, even in industries that look successful in the short term because they're worried that there'll be a secondary collapse that affects those industries. Then we tell you that actual recovery comes from things like government and bank liquidity. And so investment doesn't matter because symmetrically it doesn't happen. Additionally, I think that we tell you that to the extent that there's a demand shock, so if a certain industry totally falls apart, other industries are also badly affected because of the things that there's fewer people willing to buy. The result of this is that to the extent that hedge funds, even if they can allocate to successful industries, those industries won't be successful for long to the extent that you have a huge number of people get laid off from the airline industry, and that hurts the economy in general. Third of all, I think that to the extent that the market is crazier on their side of the house, you just get less general investment. If investment matters, then probably it's worse. But lastly, I'm just unclear why investment even matters for successful industries. The mechanism that we gave you for why investment and stock prices matter for unsuccessful industries is they need short-term liquidity to be able to pay their paychecks to the extent that the company is not doing well. But if the company is doing fine, then I don't care what their stock price is, because either way they'll make it through the crisis. Either way they'll have a recovery that's okay, right? So I just don't understand what the stock price or the price of the stock of the company has anything to do with overall economic conditions if the company is going to survive either way. It only matters for companies that won't survive, and those are the companies that we save uniquely on our side of the house. I'll take the POI.
So the logic was never that you would sell them, you would immediately begin investing during that short-term period. The logic was other actors will crash the stock anyway because clearly they don't want to avoid losing money. When these investment and hedge funds don't have any money during the recovery period, they won't be able to invest at all. The investment clearly creates new businesses, new economic activities, new ventures, thus stimulate the economy.
Yeah, so first of all, I just think it's I think that other groups are also able to invest in new industries. So I think that even if it's true that or other that pension funds and stuff are a bit slower, I think we're willing to take that marginal slowness trade-off if it means that you don't have industries collapsing, etc. Second of all, I think that it's untrue that I think that there's still a significant amount of money that hedge funds are going to be able to have under either side of the house, and so probably the margin in terms of the very long-term ability to invest is not that large. Okay. Also, I think that note that there's a significant extent to which there's less selling on our side of the house. One, I think that hedge funds are likely to sell more than other economic actors for two reasons. One, they oftentimes engage more in things like puts and futures, which require constant maintenance. This means that they have a higher incentive to sell off their positions to maintain other positions than other areas like pension funds, which don't need to do this, so probably sell less. But second of all, they're expected to react quickly and constantly be on top of the market. People accept that pension funds might slightly go into the black occasionally, and this means that other groups are less likely to panic sell, and so probably it's much better. The weighing here is then twofold. One, I think on an ounce of prevention is worth a pound of cure to the extent that you prevent bad economic activity in the first place. That's good. Second of all, note that I think even if pension funds lose money, that's far worse than large hedge funds, which serve rich people anyway. So the people who are actually affected are far better on our side of the house.
All right, we thank government rep for that speech. A reminder for speakers to also time your POI so that you don't go beyond 15 seconds. Moving on to opposition bill.
All right. I'll take POIs verbally, by the way. The failure in the government is reflective of what causes market failure, because having a myopic view of the timeline of the round restricts our ability to question what exactly is supposed to happen next. And our ability to have a much more long-sighted and permanent future of the economy is precisely what wins opposition the semi-final. There are two main goals that both teams have to resolve in this round. Firstly, which team better recovers within the crisis that is currently happening? But secondly, how are we able to develop long-term protections in the market against other crises and to avoid them in the future? I'm going to start my clashes by being very charitable and will engage with their metric of how do we recover within the crisis. I think at this point, it is worth noting that Gov claims the crux of crisis recovery is the buffer time to gather knowledge because crises are caused by a lack thereof, and therefore we need to not do anything until we know the situation, and that's when we're able to start spending, that's when we're able to recover. But they don't actually tell us what actions they're defending, because their model doesn't account for the degree of shock that has already been accrued in the market. The waiting period occurs while an active harm is currently occurring and has already occurred to these stocks. So that means while we may not have all the information, there are things that buyers and hedge funds do know, that A, something has happened to make the value of the stock far more inefficient. B, other actors in the market, like individual investors, like smaller hedge funds, will still sell the stock, causing the stock to continue depreciating as we wait. But C, the value of the stock has already depreciated to begin with. So all of this means that investors are given plenty of clues that they should be already pulling out, but it cannot due to the stringent policies. What this means is that when their waiting period in Gov is over, the same amount of panic selling will still occur on the Gov by investors who wish to cut their losses, because the only advice hedge funds give to them is to sell. But on a comparative that they give but on the comparative, they get far less money in return because they did nothing while their stocks were depreciating, so they're selling at a much lower point than they possibly could have. The additional and unengaged harm that they then face is the loss of buy-in into the hedge fund. Into the hedge fund. So on a comparative, where we may have given these people time to react quickly, your hedge funds restricted the ability for buyers to sell their stocks. So after the excruciating wait of telling people they cannot sell, and you only come back only to give them the advice to sell, that means that these people pull out their funds from these hedge funds because they can cause them to go bankrupt, because they're no longer viewed as reliable sources of advice. They're no longer viewed as reliable institutions to put their funding into, and that's why it causes hedge funds to have far less buy-in towards the end. This is the crux of the Gov case you can buy at best, because ultimately, side government promotes inaction. Insofar as they're unable to prove that your inaction is able to somehow magically wave a magic wand and solve this market crisis, it is impossible for them to prove that they have any solution to the crisis at all. What do we give to you on a comparative op? The main attack of the Gov is to assert that selling is bad, that mass panic accrues, and that people will start to sell even more and more down the line. To an extent, this is true. More people will sell on our side. But this attack is myopic because they fail to question what happens after people sell. We say that selling is the first and step to economic recovery, and it's the most important and crucial step because it allows for people to gain access to liquid capital. Their assertion that these hedge funds don't need liquid capital because they represent trillions of dollars in the market is empirically untrue, because A, most of these trillions are not liquid. They exist in the market, so they can't spend it immediately. B, if they have trillions of dollars in the market, then a failure in the market, like a crisis like this, represents the loss of billions for these hedge funds. So the bigger that you are, the more money that you lose. That's why even these crises are of major concern to these hedge funds. So there's an immediate scarcity for liquid capital that we must fix at this point. Why is this important? Because access to liquid capital is far more proximate to the crux of crisis recovery, and because the only way to recover from an economic crisis is to re-spend and re-stimulate the economy. It should Ashley and Ian gave you plenty of reasons for why economic crises and market crises are often caused by a major drop in the trust and in confidence of investors in these particular stocks. And that is why, as people start to sell even more and they start to pull out of their funding, that means that there's far less money circulating within the market, and so the the value of that stock particularly falls. That's why the vast majority of times, the priority that we must have is to put money back into the market. It is why the vast majority of practices we use to recover from crises rely on putting more money into the market, like the use of stimulus packages or drawing from reserves from the government fund. Why are they likely to re-spend their money in our case? Their push that people don't know where to spend finally comes up in GovWhip. But we then use our analysis of a waiting period against you, because we accept that we can wait a little bit for an initial period to get more information about where to spend. They will probably know where to spend later. But the difference between us and you is we got to sell first. And that means we have far more cash in hand to be able to put back into the economy. So after the period it takes to get more info, then these people are far more equipped to re-spend. Why is this exclusive? On Gov, they never get the capital that they needed, because the ability for them to rebuy and re-spend onto other industries and other stocks is limited by the amount of money they've already put into stocks they are forced to hold. That means they have to take on additional expenditures, they have to take on additional costs, and these people are far less incentivized to continue re-stimulating the economy if they're already forced to hold something that is already depreciating for them. When we allow them to get this particular funding and liquid capital back, we allow them to make the choices that they needed in order for them to act quickly. And on this, the strategic conclusion is we gave you far more ability to re-stimulate the economy and to recover from this crisis immediately. Before I move on towards the second clash, I'll take a point.
Mass selling happens when there's a panic. When prices have settled and economic conditions have improved, there's no longer this panic, so people are less likely to sell all at once, which means that all of your analysis on how this happens either way is just patently false.
Yes, but mass panic happens over the course of your waiting period. So as you're doing absolutely nothing, mass panic has already happened. Other people outside of these hedge funds have already sold their stocks. That's why your stocks will still depreciate as you wait and you do absolutely nothing. So you sell them at an even lower price compared to where we can sell them on the opposition. How do we prevent future crises then? And it's the unengaged and far more important nuance given to you from the start of our case. The reason why we must make this debate on market innovation, the reason we must focus on preventing future crises is because the effect of this policy is far more constant. We're evaluating the effect of this single current crisis against the infinite number of crises throughout the government's future. Why do we take this clash? What is the completely unresponded nuance we gave you from the start of our speech? We told you, when institutions and when hedge funds here, they will not be able to sell the stocks that they want to securely sell. That means that they are also less incentivized to spend when the economy is at a normal state. And that also means that there's far less money being put into the market to begin with. If your crises were caused by a lack of confidence, you inspired that lack of confidence before it even began, because you told them there is no way for them to get out. You told them there is no way for them to fix this problem. The takeaway from this speech at the end is we allowed you a solution. Government told you we must wait for information, but that's all they could do. Wait, and lose.
All right, we thank the opposition rep for that speech. That concludes the constructive part of this debate. Moving on to the reply portion, calling on the opposition reply.
Hello, just checking audible.
Yes, you are audible.
So not gonna lie, the world has had a tough couple of years recently. We had the election of Donald Trump. We had the crisis of COVID-19. After that, we had Omicron, Delta, Zika. We had the election of Liz Truss. We had the election of Rishi Sunak. We had multiple prime ministers of one of the largest economies of the world resigning one after the other. Any one of these and every one of these caused the Dow Jones to depreciate by over 10 points, well over 10 points in some instances. Every one of these would have caused a freeze. The question that hedge funds will be asking themselves is, will any one of these crises spiral on the government benches world? And if the answer might be yes, those exact same irrational investors will begin selling really, really fast. And when other investors see that these hedge funds, which government bench says are an important signal, start selling so fast, they begin selling as well, because no one wants to be left holding the bag. What government bench has successfully done is multiply crisis. Sure, they don't do it every week. That's obviously not what we said. Do not misrepresent us, GovWhip. We told you that there are just more crises, not that one will happen every week. If these hedge funds wanted to diversify their portfolio to avoid risk, they clearly would have done so already. It is an assertion for them to say that they will. But what this clearly does is increase the number of crises that occur. This is deadly. Every sob story that they tell you happens more often in their world. Every person losing a job happens more often in their world. Governments spend their reserves so that when it comes to a time of crisis recovery, and their own mechanism is we want the government to reinvest. Where does the government have the money if it's already spent its reserves on previous crises? Think about it. Their ability to recover crisis is directly proportionate to the number of crises that occur. We don't have to prove to you that a crisis will occur every week. That's obviously a dumb burden. But if we prove to you that crises happen twice as frequently or 2.5 times as frequently, that's already deadly to the government case. Even if we recover from each one of these crises faster, the sheer drag that it takes on our economy, on our reserves, is not worth it. But even if we don't buy the idea of crisis, we give you the independent, unresponded to impact of the economy as a whole growing slower. When large hedge funds are no longer a viable investment because clearly you have hedge funds which might force you to hold on to stock as it depreciates and everyone around you sells, why would investors trust that as a business model? Sure, hedge funds investing more carefully might sound good on paper. In reality, it looks like hedge funds not investing full stop. In reality, it means that fewer businesses start up. In reality, it means that fewer people get jobs on normal times. And given that the harm of the economic crisis is people don't get jobs, that sure, it might happen on a smaller scale, but it happens throughout all of time. You should weigh that very, very heavily in this round. But let's now talk about the only issue government wanted to talk about and the only leg they had to stand on in this round and prove to you that that leg was broken as well. Why do we recover from economic crises faster? We tell you that these companies have trillions of dollars as per DPM, that these companies need liquid capital to reinvest after the crisis. They tell you that we don't need them to reinvest in the week of the crisis itself. Of course we don't. But after the crisis, if these trillions of dollars have now been depreciated to billions or hundreds or even scary, tens of millions of dollars, these are billions of dollars that are gone from these hedge funds that are locked in inefficient sectors of the economy that could have actually just done better as cash to be reinvested later, that these companies now no longer able to sell. This means that, number one, they cannot invest. But beyond that, they cannot act as a positive signaler. They tell you that other companies look towards hedge funds as signs that the economy is going to crash. We point out that the opposite then must be logically true. They also look at these companies as signals for when the economy is going to recover. But when these companies don't have the money to invest en masse and they can no longer create that signaling effect, your economy doesn't recover. At the end of the day, GovBench loses that trade-off that they don't even bother making. They cannot recover you from the crisis better. They create more crises and they don't then don't make it through this round. Thank you.
Okay, we think the opposition should reply for that speech. To conclude this debate, government reply.
Okie dokie. Two claims. One, why selling during crisis is bad for firms and prolongs crisis. Second, why we prevent crisis in the first claim, which is logically prior to any other arguments in this debate. First, why do we think this makes and prolongs crisis? We think there is structural opaqueness or lack of information and failure of models, which means decisions that are made are not based on market efficiency, but are based on flawed information. Two, there's immense pressure from panicked investors to sell positions, and you sell otherwise good positions based on poor information. But the most important mech that comes out of my first speech and is never responded to is that you sell otherwise good positions to shore up things like puts or shorts, and you have costs, and therefore you have to sell otherwise good positions that you wouldn't otherwise sell. Note, these types of shares that are being sold are not the ones that start to go down at the start of crises, but other shares that would have otherwise remained stable, which means you expand the scope of the crisis and mean that you not only short the shares of the stocks that were failing otherwise, but you fuck over stocks that would have otherwise remained stable in order to pay off other positions that you have due to the panic of investors. The approach from op is that people sell before crises, which means you probably get more crises on net. There are 4 reasons why this is not true that we get out of the whip and the DPM. First, the reason that people sell during crisis is because everybody else is selling. There's a race to the bottom, so you want to sell to prevent loss. At the point at which the vast majority of the market is not selling, right? The vast majority of hedge funds are not selling these positions. We never get these initial panic signals, which means that people are never actually going to have an incentive to sell in the first place, which means the strategy just is not applicable. Two, we think it's just not a sustainable practice, right? Hedge funds are probably provide higher returns. They're probably going to adapt their strategies. At the point at which hedge funds are acting like super trigger happy in terms of in response to every single potential dip in a stock, we think it's just a hyper irrational position, and they're likely to adjust their strategies to accommodate for the system. We think there's probably a degree to which their characterization is just unreasonable. Third, we think the push then they say is, well, hedge funds can't sell, but other investors sell rapidly during crises, which tank these stocks. There are two reasons this doesn't make sense. First, hedge funds act as massive signals to start panic sales because hedge funds are more likely to sell prior to pension funds because hedge funds have access to more information, and therefore the people who act as the meaningful signals of the hedge funds themselves. But two, we think even if these other pensions sell, we think that hedge funds are just represent a large percentage of the market, maybe 50, 60% of all the shares that are being sold, which means only 40% of the shares are now being sold on their side of the house, which limits the degree to which the stock price can, like the floor to which the stock price can decrease to. So maybe people still sell, but the actual scope and degree to which the price that hangs is limited because hedge funds represent such a large percentage of the market. Two, then, the push that we get is that we get better recovery from crisis on their side because we capital to invest. What is deeply unclear is why you actually need that short-term injection of liquidity in order to actually invest in firms. First, we tell you that you pull money out of otherwise good firms for the reason that you want to sell stocks in order to shore up other positions due to uncertainty and panic. We tell you then that more firms fail on the comparative than would have otherwise failed, which means the scope and scale of the crisis, which means the necessity for investment becomes larger on their side of the house when you prolong and expand the scope of crisis. Two, you just don't invest in crises regardless. Note that there is a lack of information. It's very risky for firms to invest during crises, which means that they often stand on money or sell off positions and hold it rather than inject this money into the economy, right? Which means that the degree to which you're actually injecting liquidity is probably relatively limited. Three, it's unclear why you need liquidity immediately, why you can't just wait a few days after the crisis and then sell your positions in order to actually invest in the firms. But four, we think the actual mechanism by which you recover from crisis is predicated on the basis of taking things like loans against your assets. It's very unlikely that you get mass injection of capital from hedge funds to bail you out. It's actually from loans and the government. So this is not the mechanism by which people recover from firms. They also say nobody invests in hedge funds. The hedge funds still on our side provide a comparative advantage of higher risk and higher return relative to other things like pension funds or index funds, which means people still have an incentive to invest in them. Two, why we rank crises. We tell you that hedge funds, in status quo, engage in very risky behavior because they have the first mover advantage and they can profit with stocks like tank because they can sell them and then buy the dip or whatever. We say that we actively discourage firms from engaging in this type of risky behavior in the first place. We mitigate the risk or the instability of the market, which means we just prevent fewer crises in the first place, which is logically prior. And note, all of their analysis about more crises because they'll get some price signals cause people to panic are caused by the risky behavior that hedge funds engage in the first place. So we actually stop the cause of the risk that they're concerned in. But two, we prevent, Second, and finally, on the efficient allocation of capital, we just tell you that structurally, the nature of crisis means that people are based on false information, which means you don't actually make rational decisions. And when you sell or take action during this crisis, it's predicated on structurally flawed information, which fails to achieve market efficiency. Because we actively don't, I think for all of these reasons, we are so proud to propose.
Okay, we thank the government reply for that speech. We thank the readers for what is a wonderful debate. Please cross the house. The announcement will be made later on in the main Zoom call. Thank you very much for this debate.
Got it. Thank you so much.
Thank you.
Thanks a lot, everyone.